Okay, so very good evening to all of you. I can see some of you are highly inquisitive about why the class has not started yet. So there were some technical issues. That's why, we are living in a electronic mode and digital connectivity. So sometimes the connectivity issues are there. So anyways, very good evening to all of you. Today we are going to share about money demand. Okay, concept of money demand. I hope all the concepts what we have shared in the past are all clear to you. And if you have any queries, you can always share. That will be taken care later. Okay, based on as such, I am taking care of your queries as recurringly when you keep on posting here. So today we are going to discuss about very interesting topic, that is concept of money demand. Now this is normally people have this notion about economics, that economics is all about money or the world is all about money. So have you ever thought about that? Why money demand? Why do we need money? Why do we demand money? Why cannot we have any other thing to transact, to buy goods and services? Why the price and money you need is more in the quantum? So these are the factors. So today we are going to share about money demand, that why people create demand for money, and why is it important to understand that what are the factors which govern demand for money. And then we have shared disposable income. We have shared that disposable income gets affected because of the tax rate, transfer receipts. We have shared that how inflation makes impact in terms of disposable income. And if we talk about inflation, that's about increase in the price level. And when the price level goes up, what happens to your rupee value? You can buy with the same amount of money, you can buy less. So what happens when there is high price level in the country? Then, as you see, the petrol prices are going up, the overall prices are going up. So what happens because of that? You want to keep more money in your hand, no? So you want to keep, I'm not audible. Hello, am I audible? Okay. So you can hear me? Okay. So we are going to share today. Here I'll talk about crowding out. I know we have not covered it last class. I'll take care of this in the end. Okay, so don't worry about that. So now we are going to share with respect to the concept of this money demand. And okay, so you can see this. Yes, we are going to share about today introduction to money, what is money is all about, and followed by that why money is required. So first and the foremost, what is money? Why do we need money? What is the need to have money with? Okay, so then about money is a medium of exchange. You see that you have two commodities. You have money in your hand, let's say 100 rupees with you. And there are goods, and number of goods. You can buy apple, you can buy oranges, you can buy Coke, you can buy Pepsi, and so many other things. So what do? You give money, in exchange you get goods. So that's the value, medium of exchange. So money is used as a medium of exchange. You can buy anything and everything by exchanging money. That is, and it is a mode of payment. So you make payment and you get in exchange. but other things like your other things which you can exchange, but not necessarily that you are going to, you're making the payment for that and in return you are assured to get something back. Okay, so that is money is a medium of exchange and it is a means of payment. Then money is the set of liquid financial assets. What do you mean by liquid financial assets? Liquid financial assets is that we have shared national income of the country. So national income of the country is maintained in rupee crores. So that is about the financial assets. So you say about countries, we talk about debt of the country. How much debt do we have in the country? That is also in terms of liquid. Okay, so you talk about your assets, you talk about your liabilities. That's about money. And the change in your assets and liabilities depicts about the variation in the total amount of money which you have. Okay, then money gives you the purchasing power. So suppose, let's say the inflation in the country increases. So inflation is 5%. If the rate of inflation goes up to, let's say, 7%, then in that case, what happens? The same 100 rupees, with same 100 rupees, you were able to buy 1 kg of apples. Now you can buy half a kg of it. So what's happening? The purchasing power of rupee is decreasing because of this. Okay, so purchasing power decreases because of the increase in the price level. Then money is with intrinsic value. What do you mean by intrinsic value? If you have rupee with you, if you have currency with you, okay, then in that case, if no value would have been assigned, let's say this is a paper and this paper has no value assigned to it. How much is it for? Is it having any value? Is it having any value? It is only having value when it is a currency as such, isn't it? So when you say that it is currency, then only this paper has some value. Otherwise, it is having no intrinsic value. So intrinsic value, but you have gold, you have silver, you have other things which have intrinsic value. So you can go for selling gold and buy something from that. That means gold itself has some value, and because of that you get. So metals, precious products have intrinsic value, but it is not having any value of the commodity as such in the case of intrinsic value in the case of money. Okay, then money is a fiat money. Fiat money means it's a legal tender. So it's written that if I pay you 100 rupees, you know that 100 rupees, you are getting 100 rupees. So you can go for taking that 100 rupees and you can use it anywhere and it will be acceptable as 100 rupees. Nobody can say that I don't want to accept 100 rupees. Because if they want 100 rupees transaction you have done, so its value will remain 100 rupees anywhere and it will be acceptable, isn't it? So that's about the fiat money or the token money concept. Okay, thank you so much. I'm audible. Thank you so much. Okay, so this is what we have shared. Now the okay, so you can see here functions of money. So what are the functions of money? Why do we need money? So you understand that there are different parameters. Core is medium of exchange. You can buy anything by giving money, isn't it? And the value of money changes. Why value of money changes? Because of the inflation in the country. If the price level goes up, with the same quantum of money, you can buy less. If the inflation rate decreases, with the same amount of 100 rupees, you can buy more apples, isn't it? So money has basically 4 traditional functions. One is medium of exchange that you understand very well. What is? You can pay for goods and services you can get. Then you understand the double coincidence of want. What is double coincidence of want basically means? For example, we say, I hope you know this. Absolutely, just read. When we say about double coincidence of wants, so what is double coincidence of wants? Double coincidence of wants is that let's say there are 2 people. Okay, so the fellow is A. And the other is B. Now this A fellow needs, let's say, needs apple. Okay, and B needs, let's say, sugar. Okay, but B is having apple, but A requires apple, but does not want to go for sugar. Okay, A can give apples to B. So A can give apples to B, but the fellow doesn't require sugar. Now, how the exchange will be done? Because this fellow doesn't require sugar, this fellow requires apple. There's no coincidence of bond. If A would have said that, yes, I need sugar, and B is having apple, B wants apple, so A is having apple, they could have exchange. That is, now since you have rupee in hand, this problem is sorted out. So you do not have a problem here in terms of going for one for the other, isn't it? So that's the concept of double coincidence of want. Is it clear? Double coincidence of want is over because of the concept of what we can use through this concept of your money. Okay, money. Because of money, you can sort it out. Absolutely, absolutely. Okay, so the next is store of value. Store of value means you have 1,000 rupees, you have 100 rupees, you can keep it for 5 days, 6 days, 7 days, 100 days, 1,000 days, and you can go for using it later date, isn't it? So you can use it. So the value remains same, 100 rupees will remain same only. It's not that you have kept it for 5. But if you have a property, okay, if you have a property, if you have something else, then in that case, what happens? House, people buy house. That is also a way of creating money in the future, isn't it? But when you buy a house, if you leave it like that for 3 years, 5 years, 6 years, 10 years, what is going to happen? It will depreciate. Depreciate means its value will go down, isn't it? Value will decrease. Same thing happens with any other asset when you have. So that's the difference between money and any other asset you have. Okay. So it has a abode of purchasing power. That means you can buy the good, whichever you want to buy with the amount of money which you have, but it has a store of value. Okay. So it maintains value. Assets value will remain 100 only, 1,000 only, 500 only. It enables to transfer purchasing power from present to future. So you can go for keeping money, and then future you can decide about after 10 days, I'll buy something nice for me. Okay, so that you can do it, but there's no problem in terms of buying in future if you have money today. Then you can go for keeping your money in stock over the period of time. And if you keep your money over the period of time, that means you're creating your wealth. So if you keep on saving money today, tomorrow, in future, then you develop wealth in the future. Okay. Then you can decide about purchase and sale transaction at different point of time. So you can have different point of time in terms of purchase transaction and sale transaction. Means you purchase today something, you get money today, and you can go for buying tomorrow. You purchase something today and you can decide about selling at later date. So you purchase the car today, and after 5 years, you feel that you want to sell it off, and you have a bike, you have a mobile today, you want to sell it at later date, you can do it. But it's only because of the money component which is there. No, so money is helping you to buy product today and tomorrow. So it's the same amount of money can be used to purchase today. It can be used to go for sale transaction tomorrow. So money has basically store of value. Okay, that ensures your purchasing power. If you have money in your bank account, then in that case, you know that you can take out that money at any point of time, and that will have the same value, which makes you to buy goods and services at the future cost, at the future date. I'm sorry. Okay, so permanent store of value. There's difference between permanent store of value and money as store of value. So money is a temporary, because you use it for a specific purpose and then it gets over. But if you have a house, if you have a land, if you have bonds, what happens? You have to keep this, no? There is a cost involved of keeping these things. But money, is money involving any cost? No, you can keep your money. Unless you keep it somewhere where you have to go for some storage. But as such, money is not having any storage cost. Then it is liquid. So if I have money and I want to go for buying anything, I want to settle my dues, I can do it one go. But God forbid, if you have some loans outstanding, if you have some debt outstanding and you want to repay it, and if you have land with you and through land or house you want to pay it back, or through bonds you want to pay it back, then in that case you have to go to or through shares you want to go for paying it back. Then what do? You have to sell it in the market. You have to sell it in the market. Maybe some brokerage you have to pay to the person who is making transaction deal. So over there's cost involved. But in the case of money, There is store of value, but there's no storage cost involved. Okay, so that is the difference of the concept which you can see. Okay. So the next is just 1 second. 1 second, because so functions of money, medium of exchange is clear. Then next we are talking about unit of account. What is the value of unit of account here? Unit of account is that if I say that I have debt, can we write answer as per your points or in para or in exam? You can write in points also, that's not an issue. Okay. So if I say unit of account, so unit of account basically when I say, just हमने Sri Lanka की बात की. Okay, so we had spoken in the last class about Sri Lanka. So Sri Lanka has debt. Now debt, how do you quantify that debt? You quantify by that debt in terms of how much amount of money Sri Lanka has to pay. For example, you say that, so everything is quoted in terms of price. There's price involved. If you go for taking loan, then in that case, there is 1 lakh rupee loan you have to repay back. So that is unit of account. So money gives you, it assigns value, isn't it? So when you buy a house, when you pay fees, then you know how much amount of fee you have to pay. So again, this is unit of account. Okay. So when you buy something from the market, there's some price attached to it that is known as unit of account. That simplifies the process, because if through money you can unify way of calculating, isn't it? So am I paying more? Am I paying less? You are able to differentiate that. And according to that, you can decide about which good you want to buy. So it has unit of account, which is in the form of price of the good, price of the service. Okay, so it facilitates pricing process. Then we have already shared unit of account value varies. Why it varies? Because if inflation goes up, then in that case, the same 100 rupee will be able to buy less quantum of apples, less amount of apples, isn't it? So that is value depends on its purchasing power. Value of money depends on purchasing power, how much you can buy. And if you go for simply exchanging goods and services, then what happens in the case? Enlarge the screen. Mukta, this is not the class for national income, so do not post this again and again. Please do understand, if I'm sharing money demand, we cannot talk about national income question. Okay, so do not post about such kind of questions. I hope you people are sensible enough. You know which topic is going on, and the topics queries can be taken with respect to that only. Okay, so this is clear. Unit of account is clear. What about deferred payments? Deferred payments, when we talk about that, you take on loan and you repay at later date. Credit transactions. You have gone for some sale of goods and services, and you're going to get the payment later date. Deferred payments in the future date. Okay, it helps in capital formation. Government of India decides about that. We are constructing roads, we are constructing flyovers. At which date we are going to get it in the future, the returns from that. So that is a deferred payment. Okay, it helps capital market, also financial market. You buy shares today, then you see that future date, what will be the price of those shares? Will be gaining capital gain in future or not? If we gain capital gain, how much will be the gain percentage? If we have invested 1,000 rupees today, are we getting 5,000 rupees? Are we getting 6,000 rupees? Are we getting less than 1,000 rupees what we have invested? So that is about deferred payments in the future. Okay, so future date, what you will be getting about that's a deferred payment. Then inflation and deflation. What about inflation and deflation? We have already shared. If there's deflation, what happens? The impact of money is less, isn't it? When there's inflation, the impact of money goes up. So this is the factor which, because the money, same money, In the case of inflation, its impact is less. Same money in the case of deflation, impact is more. Efficacy means impact. Okay. So efficacy simply means impact. So money units are for the long-term transactions. I've already shared, if you go for loans and others, when you say that this is the amount of loan, that is about unit of account. But when you are going to pay that loan at a later date, that is about deferred payment. Okay, so deferred payment is when you're going to pay it at a later date. That's about deferred payment. Then money characteristics. What are the characteristics of money? What are the features of money you can see about? Absolutely, Hitesh. Absolutely. So money characteristics, we all know. If anybody is offering you money and other person says, I have this gold, you give me money in return of that today and I'll pay you later date. You will be hesitant. Maybe you would be hesitant because you don't know the quality of the gold, how pure the gold is, isn't it? But when we talk about money, you say that this is the quantum of money I want to pay and I want to buy this product, anybody will be there. So money is generally acceptable, isn't it? Do you mean by fiat money? It is a legal tender. If you have money, the other person knows that it carries value, isn't it? So they can go for further transactions. If you pay to A, B can go to B, B will go for buying something, it will go to C, C will go for buying something, it will go to D, and so on and so on. But everybody will be accepted. So that is generally acceptable. Durable, unless you are not able to take care in terms of money which you have. Deflation, just brief, we have already shared deflation in the prior classes. Deflation when the price level is too low. Inflation ka opposite, when the price level is too low. And inflation is when the price level goes up. So if the price level goes up, aapke liye money ka importance badh jata hai, isn't it? But the impact is less because you can buy less and effortlessly recognizable. Recognize kar sakte hain isko. So anybody you show money, they are readily accepting it. It's a durable thing. You can keep money for a longer period of time and it remains like that. Only you saw during demonetization, people had old 500 rupees and so on. And they, from decades, they had kept. So it was intact, isn't it? So it's durable, not easily reproducible because it's a legal tender. So people can not go for producing. And you have seen that deferred payment is that you can pay it at a later date. So for example, credit payments. Okay, credit payments, you have money, you say that I've got goods on credit. You will say that, let's say exporter and there's an exporter. Okay, so exporter has sold the goods to US. And the fellow says that the price, I have sold you goods worth 100,000 rupees. So its value is written 100,000, but abhi aapko paisa aaya nahi. But when it will come 100,000 only. Okay, so you know that deferred payment is there when you go for dealing in credits and at a future date. Then in that case, you get it in terms of deferred. Okay, so that's clear. I believe just read. Then portable, you can easily carry it from one place to other, isn't it? So it is easily you can carry it easily from one place to other. It has uniformity. Whether you are in India, whether anywhere, rupee is rupee, isn't it? 100 rupees rupee only. So it has uniformity in terms of acceptance, in terms of transactions. Okay, then it is divisible. 100 rupees ko aap 20 ke 5 mein kar sakte hain. You can have 10. So different denominations you can have, but the value will remain same, isn't it? So some people say that give me change of 100 rupees. So if you're having 100 rupees, so you're going to give change of 100 rupees, but the value will be 100 only. So the denominations may be there of that currency, but the value remains same. Okay, so these are the money characteristics. Very, very broad concepts, which all of us understand. But more important for you is to take care about theories, because that is very important. And the way the money is, basic functions of money. Okay, so why do we demand money? There are different theories which are given for money. Okay, so we will be talking today about money demand. Why money people demand for money? Okay, so one is about you can buy, if I have 100 rupees, I can buy real amount of goods and services, isn't it? I'm buying the things which I want to buy. So this is giving me option to buy goods and services. Real money balances means how much I can buy through that in terms of goods and services. That is real money balance. Okay. People hold money. Why do we keep money? We keep money because we want to have liquid money we can buy. We can do shopping. We can buy essential goods. So it creates liquidity. It creates, I'm sorry for this. It creates liquidity. So you have liquidity and that's creates your purchasing power. So you want to keep money as cash. Okay, so you keep money as cash because that helps you to, that creates liquidity anytime that cash can be used to buy goods and services. Elasticity of supply means the amount of money in circulation that changes. Elasticity of supply from one person to other. The elasticity of supply of money that is less elastic as compared to demand for money. Supply of money is less elastic because in the case, the money, you can keep money as cash, you can keep money as bond, you can keep money as shares. So the value of elasticity supply of the money varies, no? Depending upon elasticity of supply varies, depending on how do you want to keep. Do you want to keep more cash as money? Do you want to keep more money and in the form of investments? Okay, so that's about elasticity of supply of money. Then demand for liquidity or store of value. Store of value, आपको बता दें, you can keep it as cash, you can keep it as bond, you can keep it as shares, you can keep it in terms of gold, you can keep it in terms of NSC certification, NSC, and any other thing. You can keep as saving deposits, isn't it? So there are different ways you can keep your money, and that's so the money which is in cash is the most liquid money. Liquid money means अगर आपके पास gold है, that is also having value in terms of money value, but it is less liquid. So nothing is as liquid as cash. Closest form of. But if you need money, you can go for selling your bond. You will get the money. You'll get certain amount of money, but it's not as liquid as cash. Okay. Why consumers and firms hold money as opposed to in any asset form? If you go for anything, you buy bond, you buy property, you buy gold, you buy shares, you buy any other thing, that's your asset. And you get return on that asset. You put your money in saving deposits, you put your money in FDs, you get return, no? You get certain rate of return. So that is about rate of return. But still people want to keep more cash as compared to keeping it in the form of any other. So let's take inflation, okay? So if inflation is going up, what will you do? If inflation is higher, if the price level in the country increases, will you keep more cash or will you go for investing more in assets? What will you do? And why will you do it? One answer for this. If inflation goes up, my question is, if inflation goes up, will you be keeping more cash or will you be investing in other assets where you can get high rate of returns? What will you do? Obviously, you'll keep more cash, no? If inflation is high, why you need to keep more cash? So the money demand goes up. Why money demand goes up when inflation rate is high? Because everything becomes expensive. Everything becomes expensive means you cannot afford to keep your money in locker. You cannot go afford to keep your money more for savings. You have to have more cash because your products have become expensive. So you need more money to buy things. Okay, so when inflation goes up, what happens? You keep more cash. So money demand is a determinant of interest rates. Now, if inflation goes up and you create more money demand, isn't it? If inflation is high, you create more money demand, you want to keep more cash. So what RBI will do? RBI will increase interest rates. So what happens in the case of inflation? Interest rate goes up. Interest rate goes up. That means the opportunity cost concept समझते हैं आप? What is opportunity cost? What is opportunity cost? Opportunity cost is if I go for keeping cash, then in that case, how much interest I am foregoing? Let's say that the interest rate for FD is 6%. Okay, so interest rate for FD is 6%. I'm sorry for this. If I say for my handwriting, if I say interest rate on FD is 6%, and if you're keeping cash, knowing that FD interest rate is 6%, आप क्या forgo कर रहे हैं? You're not getting this 6% interest rate. So this is the opportunity cost of keeping cash. Okay, so what happens in the case of if interest rate goes up? If interest rate goes up, what will you do? Will you prefer to keep cash or will you go for saving or investing? Definitely you will prefer to invest because interest rate बढ़ गया है. If interest rate goes up, that means you will keep less cash. If you keep less cash when you keep less cash when interest rate goes up, what it means? That means you are decreasing money demand. Your decreasing money demand means you are buying less. Your buying less means inflation कम हो जाएगा. Okay, so this is how interest rate and money demand are related. I've already shared about price. If the price level goes up, what happens if the price level goes up? You create more money demand. What happens when the income goes up? Income goes up means you spend more. That is why you see rich people, they spend more and more because उनके पास ज़्यादा पैसा है. So income increases, that means your purchasing power goes up and you buy more and more. So these are the factors which decides money demand. So money demand depends on what? Money demand depends on interest rate. If interest rate is higher, then in that case, you will prefer to keep less cash. Why will you keep less cash? Because opportunity cost of keeping cash is very high. Isn't it? So you'll go for investments. You'll invest money. If you invest money, you'll have less money. You will have less money. That means you will buy less. You will buy less means inflation will go down. Same for the case of, but if income is higher, then in that case, you buy more. You buy more means you create more money demand. You create more money demand. If it is not matched up with supply, then in that case, prices बढ़ जाएंगी, then in that case, RBI will go for increasing the interest rate. Okay, so this is the concept of money demand. Absolutely. Yes, Yogita, we keep money for contingency also. Definitely. Kuch paisa, definitely. You keep it for rainy days of yours. Any problem is there, so you keep money aside. Some people go for health insurance, some people go for other things. So this is also a way of saving your money for contingencies, isn't it? Okay, so then the next concept is it helps monetary policy also to decide about shall we go for increasing the repo rate agar inflation बढ़ रहा है तो. We have shared prior that monetary policy takes care expansionary fiscal policy में monetary policy plays very important role. So if there's deflation in the economy, if there's deflationary impact, aggregate demand is less, then in that case, if government is spending, but at the same time, if interest rates are not taken care, what will happen? The impact will be less, isn't it? So these all are interrelated factors. And this depends majorly on money demand. Agar country mein money demand badega, and according to that, if there are not enough products and services, then in that case, prices increase only. If prices goes up, then RBI will intervene by going for increasing interest rates. Because if interest rate goes up, you keep more money in saving, and you keep, because you do not want to forego that rate of interest which you're getting, and cash aap kam rakhenge. So you will keep cash less and you'll buy less. Okay. Then liquid money demand. Liquid money demand depends on, liquid money means basically cash. Okay. Liquid money demand depends on income we have shared, price level we have shared, rate of interest we have shared, GDP also. GDP means if real GDP increases, that means countries progressing. Countries progressing means income will increase. Income will increase means money demand will increase. And the degree of financial innovations. So you see today, you can have internet transactions, you can transact through Paytm, you can transact through other means. What is happening because of that? Yes, Ankur, yes. RBI tries to control inflation through interest rates. Definitely, yes. Interest rate basically is repo rate, okay? Repo rate ke through karte hain, basically. So financial innovations, we're talking about financial innovations. What do you mean by financial innovations? You can transact, you have debit card, you have credit card, you have you have Google Pay, you have your Paytm. So all these transactions have made what? It has made simplification. So what's happening? Money as such in cash you do not want to keep, isn't it? So you are keeping money more in the terms of digital currency. Digital means basically digital rupee we are talking about. Crypto की बात नहीं कर रहे हैं. Okay, so that is innovations also brings change in the demand for money. So if you can transact more through, so people are believing more through Paytm and other rather than keeping cash. इसलिए आप देखिए today people want to keep less cash because they can transact more through these means. So they go for transacting today. Then so the way innovations have happened, it is helping to keep absolutely less Ankshil, absolutely right. Jitna zyada financially, some countries they do not have they do not want to keep cash. They do not have concept of checkbook. People go for more through online transactions. Sara banking online hota hai unka. So they do not rely on these things, isn't it? So the more and more financially innovative you are, adopting technology over the period of time, less and less reliance will be on cash. Isn't it? But liquidity will be there. So opportunity cost of holding money is clear. Opportunity cost of holding money is the interest rate we have shared. अगर आपको FD में bond में 6% interest rate मिल रहा है, and if you're keeping cash definitely is not giving you any interest rate. So that's the cost involved. So you have to take care about that. That should I keep more cash or should I go for keeping? Should I invest money? Should I save money? That's your choice. Shall I go for saving, simple saving account जहाँ पे आपको 4% return मिलेगा? You can go for FD. Which will be blocking your fund for a specific period. You can go in shares, you can go in bonds, you can buy property, anything, land. So people have different priorities. So this is clear of holding money. If you keep cash, you are foregoing interest. याद रखिए. So that's the trade-off. If you want to keep more money liquid, you are foregoing interest rates. Okay. So financial innovations we have shared, and you are youngsters. You realize that you relies more on e-transactions rather than going for cash as such. Okay, so this is clear to you all. Then one second. Okay, so this is clear to all of you. Where were we? We have done this. Okay. So now you can see we are talking about quantity theory of money given by Fisher. Okay. Less money, yes. Okay, so when we are talking about quantity theory of money basically means that there are two components. Can you see here? There are two components which we are sharing here. So this on the left side, what you see on the left side here, this is what? And this is the demand for money. Yaad rakhiye, this is demand for money, this is supply for money. Why am I sharing this? This is known as equating equation given by Fisher. It is known as quantity theory of money. And this quantity theory of money, M is total amount of money. Kitna money hai circulation. Okay, that's about M. V is the velocity. Velocity means at what pace the transaction is happening of money. From A to B, B to C, at what velocity, at what pace the money is transacting from A to B, B to C, C to D, and then E to F, and so on. So how many times the currency is moving from one to the other, and so on. Okay, so that's about velocity. Then P is the price level. Price level, which depicts about prices high and low, and that is basically inflation. Y is about output or aggregate supply in the economy. Okay, so output, real output. We have shared this, you know about this. Okay, so this is what M and V is the demand of money. How much money is there and at what velocity it is moving. Obviously, this money demand, if the velocity is higher and higher, then in that case, money demand will increase. If velocity is less, that means money demand will be less. So this is about total amount of money kitna hai and velocity kitna. This is money demand. And what do you have on the right side? You have money supply. Money supply is about P, price level, and income. So income and if price level goes up, then in that case, what happens? The price level goes up, real income will decrease. If price level decreases, then real income will increase. Okay, so real income depends on what price level. If price level increases, then the real income will decrease. So that's the concept here. Okay, so these are the two equations. This is the equation which is known as equating equation, which talks about the quantity theory of money. So this is about now what we do here. If we say that the velocity is constant, okay, short-term velocity is not going to change. So if velocity is constant, as per the classical economists, you remember we had shared full employment. So full employment mein kya hoga? There will be low possibility of transactions in terms of, so velocity remains constant. Okay, so let's say the circulation of money is constant. And income over the period of time will remain same. GDP is not going to increase in the short period of time. So basically the price level and the money demand depends on what price level. So if the price level goes up, money demand goes up. That's the relationship. Okay, so money demand, basically M1 is what? Demand deposits. Samajhte hain aap? What is demand deposits? Demand deposits, they have added later in this equation, they have added two more components. You can see M1 and V1. So initially it was about MV is equal to PY equal to PY. Then they have added M1 and P1. M1, P1 is what? This is cash and velocity of cash. This is demand deposits. Demand deposits are what? Which you keep it in the bank. Okay, so demand deposits are the deposits which you keep it in the bank, and you can ask, basically check. Agar aap checkbook hai aapke paas, so when you say that you write X amount of money and you go to the bank, say that this is the amount I want. So you're demanding money and the bank is giving you. Okay, so that's about the demand of the money. Demand deposits, and V1 is the velocity of the demand deposit. Guess at what pace you are going for transacting here. That is known as. So this is the Fisher's equation, which has been modified later and which is equal to T. They have replaced Y with T. Y is country's income and T is total amount of transactions which are happening in the economy. Okay, so this is the money demand. इसमें numericals आते हैं in terms of they'll out of these four variables they'll give you three variables. एक को आपको find out करना है. Okay, so this is how this Fisher's equation is about money demand. Financial innovations have already velocity. Financial innovations we have shared, like you talk about, just have Google Pay, Paytm, any other transactions which are happening, internet banking. So transacting more through debit cards. So what has happened because of this? What's happening? You want to keep less cash. You do not want to carry more cash. So people feel that it's not safe to carry cash. Let's go for having debit card and others. So what are you doing? You are keeping money less, but it is equally liquid. So sometimes we say that it is close money, as good as money. So when you go for digital transactions, banks, they charge certain amount from you. That is the hidden component. But otherwise, it is liquid as money. But it is not liquid like cash, but it is as liquid as cash. So what is happening? People are switching over, considering. But Paytm and others, what they are doing, वो आपको points transfer करते हैं. So that makes you to go for taking those services more and more, isn't it? Velocity is the speed at which money is moving from one hand to the other, at what speed it is moving from one hand to other. So if money demand goes up, then in that case, the circulation of money from within the system will be at a faster pace. Okay. Okay. So this is the next concept we are sharing. What is the theory of money? Abhi humne dekha, we had equated the equation. How did we equate the equation? You can see here. How did we equate the equation? What we did. अभी हमने क्या लिखा था? We wrote that this we wrote M. Okay, we wrote M B is equal to PY, didn't we? This is what we discussed. इसमें आपने क्या किया है? Price you have taken on X on the left hand side and V into M is there, and then you have taken income on the in the denominator. This is how any numerical can be given to you. So out of these 4 variables, कोई भी आपको 3 variables दिए होंगे, and then you have to find out the 4th one. And what is the core we are sharing? In short term, the velocity of money remains constant. The pace at which money moves, the speed at which money moves from A to B, it remains constant. Rate of change will be constant, isn't it? Velocity will be constant in a short span of time when we are talking about money supply. Changes in the money supply will result in change in the nominal GDP. We have shared nominal GDP. What is nominal GDP? Agar price level बढ़ गया, the nominal GDP will increase. So respectively, nominal GDP will increase. So that's the component. Okay. So short-term classical economists said, reason being there's full employment. So in that case, this concept was given by classical economists. So in the short term, since yes, just be right. So in the short term, what happens? Classical economists ने concept दिया है, and you remember classical concepts. What they said about? They said that there's full employment. Full employment means there's no need for government to intervene. Then in that case, if there's full employment, currency will not be changing in terms of demand and supply, isn't it? So in that case, they took care about. Classical economists emphasize that supply will be remaining same. There will be no change in the supply. Okay. So demand of money simply depends on what? Simply depends on price level. Simple fundamental rule you understand. Money demand depends on what? Price level. If the price level goes up, money demand goes up, because with the same amount of money, you can buy less and less. So you'll be buying. So short term mein velocity constant hogi. Rate of change constant hoga. GDP of the country will be depending on price level. So basically, price level is the core. Price level decides about money demand. So money demand, M, so how much money is translating in the economy, changing in the economy, depends on what? Price level. That is what is the classical concept of quantity theory of money, Fisher's concept. Okay. Classical Yukti we have already shown. Monotonically means what? Which reference to you are talking about? Monotonical with respect to what you are talking, Hiral. Classical approach basically says about that economy is always at full employment, and if there are any changes, it will automatically settle. Okay, it was given supply creates its own demand. I do not have that much time to share about. MB reflects total supply of money. MB is, yes, but velocity is constant. MB is money demand. Is money demand. MB is the money demand, and PY depends on what? The in the market. I'll share it again once. MB is the money demand, money and the velocity. How much money is there? How much money is there? And at what velocity is this transacting? It is not about money supply. It is about money demand. Okay. Then, Mansha, is it clear? It is about money demand. MB is money demand. PY is supply front. Why supply front? Because price and how much output has been produced. We have shared national income accounting. आप output की बात करते हैं, then in that case, if you talk about output, output is basically depicting what? Income for the people. Income means is the money supply, isn't it? Money supply. And it is about the money demand, which is transacting in the economy, at what pace it is transacting. Then we talk about Pigou. Cambridge was this. So Fisher gave the concept, followed by Pigou. Yes, classical. They were classical. They were classical economists, those who gave importance to the concept. So basically, money demand here, they gave importance to money as what? Money as medium of exchange, isn't it? Money as medium of exchange, because price बढ़ गया, तो then in that case, your purchasing power will go down and impact will be there. So Fisher concept was taken forward by Pigou, and Pigou said about that it is for the transactive motive. Transactive motive basically for exchange of goods and services. Okay, so transactive motive. And one more component he added, Fisher took care about only transactive motive. What he said about money demand depends on price level. But Pigou said about that there is one more component with respect to store of value. So in the case of Pigou, what he said about money demand is not only dependent on price level, but it is also dependent on income, wealth, and interest rate. Okay, so Pigou gave extension of what Fisher defined as money demand. So Fisher ke case mein money demand is only about the price level, because velocity constant hai, and output depends on what? Is dependent on price level. If price level will go up, real output will decrease, isn't it? So price level and money demand are the two components. So basically, Fisher said that money demand depends on price level. Pigou said about money demand depends on income, wealth, and interest rate. So suppose you are born rich. If you are born rich, you have wealth, isn't it? Inherited wealth. If you have inherited wealth, in that case, you will be having higher money demand. If interest rate goes up, then in that case, what happens? If interest rate goes up, you have less money demand because the opportunity cost of holding money goes up. If you have more income, then money demand will be more, isn't it? So Pigou gave this concept of money demand, extended form of what Fisher gave about. Fisher was only confined to price level in terms of money demand, but Pigou took care about not only medium of exchange as money, but also store of value of money. Wealth is store of value, isn't it? So wealth is store of value of the money. So money demand given by Pigou is about this concept of, you can see here this K, this is price level, this is income. That's the same what we had shared in the case of Pigou. This is money demand on the left side. Okay, so this case, he has not taken velocity here, it has taken money demand. Okay, now the K, what is K? K is the proportion of income you want to hold as cash. That is cash balance. So this strategy of Pigou is also known as cash balance strategy. Okay, so agar aapko question cash balance strategy se aata hai, to in that case you will explain with respect to money demand has two components: transactive motive, that is medium of exchange, plus money as store of value. Then money demand depends on income, wealth, and interest rate. Aapko pata hai what is the relationship of income with money demand, wealth with money demand, and interest rate with money demand. Then this fellow, Pigou, gave the concept of K. K is Cambridge K. It is known as Cambridge K. It basically means that how much proportion of income people want to hold as cash. So if you have if your income goes up, then in that case, what proportion of your income you want to keep it as cash? Okay, so that is known as cash balance. So more and more cash you keep, that means what? You will go for spending more and more. Okay, so it depends on it. How much more money you want to keep it as cash is dependent on what? It is dependent on the price level in the economy and income in the economy. So on the right side, you see PY. P is the price level, Y is the income. Okay, and PY is nominal income, because you remember, हमने difference किया है real income and nominal income. So what is the difference between real income and nominal income? What's the difference between real income and nominal income? Anyone here? What's the difference between real income and nominal income? Hedge means basically, means risk minimization. Okay, minimizing risk. How velocity is determined? Velocity is determined in terms of uh, what rate the currency is transacted in one to other. More and more demand. It is about. This is about the money in circulation. Because you see, Government of India prints limited number of currency, isn't it? If the currency is printed in limited number, and in that case, if inflation rate goes up, that means that amount of money which is there, it will be circulating at a faster pace. So velocity depends on the inflation rate. Higher the inflation rate, higher the money demand, higher is the velocity. Okay, so velocity depends on basically the inflation rate. Real income is base price into. Absolutely, Himanshu. Absolutely right. So, can you differentiate between Pigou and this Fisher concept of money demand? Is it clear? Is it clear to all of you? Monotonical, basically, you are referring to which hierarchical किस context में आप पूछ रहे हो, but basically it means there's no change. It is at the same pace, okay? Monotonically means same pace पे रहता है. There's no change as such. That is monotonical. जैसा आज है वैसा कल रहेगा over the period of time, okay? So now, you remember we had shared about Keynes. So Keynes was the one who proposed that government plays very, very important role. So Keynes gave the concept of demand for money. He proposed the theory of demand for money, which is totally different than what we have shared about of Fisher and Pigou. Okay, so now we are talking about demand for money with respect to Keynesian concept. Okay, so Keynes gave the concept of three. He said that money you want to keep it for three purposes. First is transactive motive. So transactive motive basically, आप transactive motive समझते हैं. Transactive motive is to transact, to buy goods and services, medium of exchange, money as a medium of exchange. Okay, so you know about first motive is सबसे पहले आपके लिए important क्यों है money? Why do you want to keep money more? Why do you want to have money? So that you can meet your expenses. Okay, so first and the foremost important for you is to go for transactive motive. So first and the foremost is transactive motive. If I have money, you have money with you. First and the foremost, you will decide about what are my expenses where I need to spend, and according to that, you will spend. So that is a transactive motive. Okay, so you keep money aside for your regular payments. जो भी आपके expenses हैं, उसको आप पहले electricity, petrol, your fees, your food, basic necessities. Okay, so transactive motive, first and the foremost. So liquidity preference theory is given by Keynes, number one. Number two, liquidity preference means we have shared that liquid means money in cash. That has the highest liquidity. And preference means why do you want to keep money in cash and how your preference changes to keep money in cash with the change in motive. So the first and the foremost motive is transactive motive. Transactive motive makes you to keep money in cash because it's liquid. You can easily go for exchange. And which function of money is it? It's a money as medium of exchange. Okay, so transactive motive taken care of there. Then precautionary motive. What is precautionary motive? So when we talk about precautionary motive, like I believe Yukti was talking about precautionary motive. So precautionary motive, okay, fine. I've met all my expenses. I've kept money aside for all my expenses, but I want to save some amount of money for my future. Not for future, basically for any adversity in life, isn't it? So you want to keep certain money aside. So precautionary motive. Then you keep money. So for unforeseen contingencies, which may arise tomorrow, anything which you feel like. So what happened during COVID? COVID, people started spending less and had gone for more of precautionary motive because they were scared, isn't it? So they were spending. So precautionary motive. So first and the foremost is transactive motive, then precautionary motive. Precautionary motive में क्या होगा? Store of value होगी. So money as store of value, isn't it? We have shared money as store of value. Then you have speculative motive. Speculative motive, okay, fine. I have gone for spending. I've taken care of my expenses. I've saved certain amount of money, and now I can go for investing in the market where I'm taking some risk. So where I go for taking some risk and want to gain through that, that is about money value as assets which I'm creating. So in the case, they have taken bond as core asset. Okay, so bonds have been taken as assets. So speculative motive is about when you see future certain uncertainties may arise about your money value. So you may get high returns, you may get less returns. That's about speculative. And you go for investing where you feel that you will be getting high returns. आप तो इसी ऑब्जेक्टिव से इन्वेस्ट करते हैं to get high returns, but maybe possible you may get less, you may get more tomorrow, isn't it? So that is about speculative motive. So Keynes proposed 3 motives for money demand. You can go for transactive motive, you can go for precautionary motive, you can go for speculative motive. Okay, so transactive motive will depend on what? Transactive motive किस पे depend करेगा? Transactive motive basically depend किस पे करेगा? आपकी income पे. Higher and higher income, so you'll have more. You will be spending more and more. Isn't it transactive motive? Precautionary motive also depends on what? If your income is higher, then you spend also and you can save also, isn't it? So if you have income, then in that case, if you have higher income, obviously we'll be able to keep more money for saving also, precautionary motive also, and transactive. So the transactive and precautionary depends on what? Income, isn't it? It depends on income. How much income do you have? Speculative motive depends on what? Speculative motive depends on interest rates, isn't it? So if you feel that interest rates will be higher, then in that case, you'll go for more speculative motive. If you feel interest rates are less, then you'll go for less, isn't it? So that is how you decide about. So basically, first and the foremost, आप क्या याद रखेंगे? How money demand switches over from the concept switch from Fisher to Pigou. Fisher only said about price level and money demand. Pigou said about that it also depends on income, wealth, and interest rates. Then Keynes said about that money demand depends on 3 motives. To keep money as liquid, your preference to keep money as liquid depends on 3 motives: transactive, precautionary, and speculative. Next, you should know about that transactive and precautionary depends on what? Disposable income. Or income, because we have shared why, isn't it? So why and income depends on what price level, because अगर price level बढ़ेगा तो आपकी income country की will be less, real income will be less, nominal will be higher, isn't it? So that's why that is important. Then next is speculative. Speculative depends on what? Interest rates. Absolutely, Himanshu, ROI. Obviously, अगर interest rates आपका deciding factor and it depends on your ROI. Obviously, you're looking for high returns on your investment, isn't it? So that's why you go for deciding about it. Okay. So next is transaction demand. We have shared transaction demand. क्या होती है basically? What is transaction demand? Transaction demand is the concept which is with about what? It is about taking care about money, basically difference between receipts and disbursements. आपके पास, you got money today and you want to go for spending at future date, maybe tomorrow, maybe over the month. You get salary in one day and you spend over the month, isn't it? So that is about transaction. That's why you want to keep money cash and go for dispersing it over a period of time. So keep money on hand to make purchases between pay period. So आपको किसी भी चीज का पेमेंट करना है तो उसके लिए आपको you get money very beginning of the month, first को, second को, 10th को, जब भी आपको income मिलेगा, उसके according you will decide for the entire month that on 10th of this I have to pay electricity bill, on 15th I have to pay my EMI, and so on and so on, isn't it? So this is how you decide about. So you keep money aside. I have to pay to the worker who's working at home, and so on. Okay, so that's transactive motive. And we have already shared there's a trade-off and interest rate. If interest rate goes up, you're keeping more cash. वो आपकी holding cost है, isn't it? It's your holding cost. So if you go for keeping more cash when the interest rates are high, that means your cost is high of holding cash. Or you can say in terms of opportunity cost. Okay, so that's the concept. So you have to decide about if I'm keeping cash, what interest rate I'm foregoing. So that's a trade-off. That's a trade-off. You have to take a call with respect to that. That's a trade-off. Am I looking for interest payment? अगर आप interest payment देख रहे हैं, तो then in that case you are switching over from transactive to precautionary motive, isn't it? So अगर आप transactive motive में हैं, then in that case you'll keep more cash. You keep more cash, that means you're foregoing interest. Your foregoing interest means that's the cost of holding money in cash. Okay, so that's what you have to decide about. So you will benefits of keeping small amount of money on hand. So if you keep more small amount of money in hand, that means the interest foregone loss will be less to you, isn't it? अगर आप ज़्यादा पैसा कैश में रखेंगे, तो then in that case you are losing more interest payments. So that you have to take a call with respect to that. So you keep less money in cash and you keep some money in bank as close to as so saving में आप रख दीजिए. So if you keep it in saving, at least 4% तो आपको interest मिल रहा है. So then you can go for withdrawing the money. So that means you're getting some return on that. So that is how you have to decide about. But if you keep more cash, then in that case, you have less money to keep it in the bank. And if you're having less money to keep it in the bank, then in that case, you will be getting less interest. So that's the cost. Okay, so that's the cost you have to take care about. Okay, so transaction demand for money. Regular payments, what you have to make, regular payments. Okay, so next we are talking about transaction demand for money. When we talk about transaction demand for money, you can see here, this L stands for what? L stands for LR is the transaction demand. Liquidity, you need it for transaction demand. Okay, money, how much money you need for transaction demand is on the left side. And this is about Y is your earnings. How much you are earning, that is your Y. And we are talking about country. Okay, remember this is country's demand because we are sharing about country. So ये आपकी मेरी नहीं है. This is for the entire country demand. Okay. Absolutely, if they want to increase. Okay, so here you can see LR is liquidity preference to keep money in cash for transactive motive. That is LR. Y is your what? Income of the country. Okay, K is the ratio of money of your total of your country's income, which you want to keep it for transactive motive. So if the country's income is 100 crore, if you keep 80% of it for transactive motive, then this is 0.8 here, K. Okay, so K depicts about what ratio of your earnings you are keeping for transactive motive, that is K. Okay, if the ratio goes up, that means money demand goes up. So transaction demand is definitely related to level of income, isn't it? It's related to level of income. Transactive demand. Obviously, country like India, country like Africa, these countries, if we talk about India, India ka per capita income higher hai. So if per capita income is higher, then in that case, people can spend more as compared to Africa and remote Africa, where people are Uganda mein chale jaiye aap somewhere. So over there, people have less level of income. If they have less level of income, obviously they'll spend less. जब आपके पास पैसा नहीं है, तो how will you go for spending? No? So transaction demand will be less. So it depends on level of income you have. Okay, so that's the concept. So transaction demand is clear. Equation is clear. Equation on the left side क्या है आपके demand for transactive motive. Y is what? income. K is what? The proportion of ratio or the ratio of earnings, that is of income, you are spending, you are using it for transactive motive. Okay. So higher the higher value of this K, higher the portion of your income, of country's income is spent on transactive motive. And obviously, if it goes higher and higher, that means आप saving कम कर रहे हैं country में. Okay. So this is clear. Now, next is about precautionary motive. We have shared transaction motive and precautionary motive. Now, precautionary motive, people are uncertain about future. People want to safeguard their life, future, like contingencies or rainy days or whatever you say about, then in that case, people go for saving. So if you're saving, then in that case, you are spending less. You're spending less means you're getting interest. So that means if you are getting interest, you have to decide about, if I want to go for getting more interest, then आपको कुछ sacrifices करने पड़ेंगे अपने transactive motives, isn't it? So you have to spend less. So some people sacrifice their aspirations and others for the sake of कि कल के लिए पैसा बच जाए. So that is about precaution. So when you go for precautionary motive, then in that case, what are you doing? You are foregoing your transactive motive, some amount of transactive motive. So it's a trade-off here also, isn't it? Obviously, one for the other. So if you go for more savings, then in that case, you are trading off your transaction demand for motive. It's implicit. It's implicit. Technology and structure of the financial system are important determinants of precautionary demand, definitely. So today it has become easy to save money online, to go for opening your bank account. You can open your bank account. You can operate everything through your mobile. You can do, you can like save money online. It has become very easy today. You do not go to the branch. You do not fill those forms. You need not wait in a like queue for this. You can easily save your money. Okay, so people can go for saving money, and that is what has become easy today. That is an important factor which drives towards more of precautionary demand. अगर आपको लगता है कि if you go for saving and your money is saved, किया है अच्छा ट्रांजैक्टिव मोटिव है. Yes, this depends on income and on interest rates. Okay, so is it clear? So we are talking about money precautionary motive. आप समझ गए हो. Transactive का opposite है बिल्कुल, isn't it? So transactive में you are keeping more cash, and precautionary you are sacrificing cash for the sake of interest. In transactive, you are sacrificing interest for the sake of keeping it cash. Okay, so precautionary motive depends on what? Precautionary motive depends on income. Obviously, higher the higher income, poor people cannot go for precautionary motive because उनके पास है ही नहीं इतना पैसा कि they can go for savings. They can only meet their expenses. They cannot go for savings. So so it depends on income, size of income. So poor countries, if we talk about poor countries, they will have less savings, isn't it? Because they do not have enough money to save. Whatever they earn, they have to spend. So that's about, so rich countries will have more savings, more precautionary motive. Okay. Ideally, it should be like this only, but it varies. It depends on your approach towards life. So that also is a deciding factor. Some people have a huge quantum of income. Money countries have huge income, but like India, maybe आप देखिए savings ज़्यादा है. People are not so extravagant like others. We in India we save a lot, especially higher age bracket. Youngsters are becoming more towards transactive motive. Okay, so political conditions also define about precautionary motive. How government is promoting savings, how government is creating conducive environment for people to go for more saving, sensitizing people, making them aware about benefits of saving. जैसे आप देखिए जनधन योजना, such kind of schemes where government is telling marginal set of people also you save certain amount of money. Okay, personal characteristics of individuals also, which like we say about in India, more youngsters are there. So definitely youngsters का approach क्या होता है? To spend more. So they will be more in transactive motive. As you grow, as you have liabilities on your head, then in that case, you switch over, you spend less and you go for more of precautionary motive, isn't it? So this is how it changes. So then is about speculative motive. So हमने कर लिया transactive motive, we have done precautionary motive, then speculative motive. And speculative motive, you understand, speculative motive is about what? Speculative motive takes care about basically it talks about money where you have money where you keep assets. You the portfolio समझते हैं ना? Portfolio is about based on your risk. You decide about, shall I keep money in the bonds? Shall I keep money in FD? Shall I keep money in shares? Shall I go for shares which are of low risk and the companies which are listed in Fortune 500? Shall I go for some players which are new players in the market? So आपकी risk appetite के basis पे आप decide करते हो that what kind of portfolio you want to create. That is speculative motive. Okay, so speculative motive takes care about store of value function of money in investments. You go for keeping money in assets and you will get it at a later date. Returns, capital gain जो आपको मिलेगा in future you will get. Okay, if we are optimistic about to get capital gain, so we'll be getting later date. So that's about store of value function of money. Okay, so speculative motive is taking care about store of value of money and where you keep your wealth which you have acquired in the past or maybe others. This will help you to go for absolutely Mansha. Investment portfolio. So आप एक अपना portfolio, it is basically basket of your assets which have different components here. Okay, and that depends on आपका risk कितना है, how much what's your risk appetite. So accordingly you decide about. So people go for diversify asset holdings. Okay, so here people go for diversify asset holding. So कुछ लोग they prefer to buy gold. Some people want to buy property and then forget about it. Some people want to invest in shares. Some people want to go for bonds का तो इतना हमारे इंडिया में नहीं है, but yes, shares people go for buying shares. Some people go for core FD. So depend करता है आप अपना portfolio कैसे create करेंगे. Depends on that. Okay, so this is for the speculative motive. So you want to go for demand for money depends here upon what expected yields. In just say one of you were talking about ROI. Okay, so return in future. आपको return future में कितना मिलेगा? What is my return on investments? I will be getting returns. What is my level of risk? According to that, you go for deciding about. So James Tobin also said the same concept what Keynes said about. Okay, speculative motive. So this is very important. See, opportunity cost आपको जरूर याद रखना है in the case of money demand theory because it's a trade-off, isn't it? So trade-off means opportunity cost. So opportunity cost आपको ध्यान रखना है. That is about holding of money. If we are keeping cash, then what is the opportunity cost? So if you go for increased opportunity cost of holding money, lowers money. See, just say one of you were talking about interest rates अगर बढ़ जाते हैं. If interest rates are increasing, then in that case, your holding cost is higher, no, of keeping cash. So what will you do? You will lower money demand. So you will lower money demand in the case if interest rates are higher, you get expected yields of yours are higher. Future may you will get more returns. And that makes you to go for keeping less, create less money demand, and you go for because the cost goes up now, opportunity cost of holding money goes up. So you do not want to keep cash. You want to invest. And this increased riskiness of returns on other assets increases money demand. If you feel that risk is higher of investments, then definitely go for keeping more money in cash. So it depends on what is the level of returns you're going to get and what's the level of risk you're exposed to. That decides about what do you want to do with speculative motive. So that you will decide based on this, okay? So speculative motive and interest rates are reversed, isn't it? जितना ज्यादा इंटरेस्ट रेट होगा उस केस में आप उतना ज्यादा लेस कैश रखना चाहेंगे. Yes. Or number two, when you believe that the interest rate is going to increase in future, then in that case, you will go for investing in future more and more. But you feel that interest rate has reached to this point, has reached point. Basically, interest rates and speculative demand are working in the reverse manner. If interest rates are higher, you go for keeping more money, you invest more, and you will keep less cash. Okay, so speculative demand depends on what? Speculative demand depends on future changes in interest rates. If you believe that future interest rates will be higher, then in that case, what will you do? For getting higher interest rates, abhi interest rates low hai, future interest rates badega, then you'll decide about according to that. If interest rates today are low and you believe that interest rates are further going to reduce, then why will you invest? Isn't it? So expected return on money is zero. जब आपको लगता है कि it's better not to keep money as cash and go for investing. So when you expect that you will get the returns through bonds, you will start investing. And when you believe that tomorrow when you are going to sell that bond, you will gain more. Capital gain आपको मिलेगा. Definitely you'll go for keeping more money in bonds, invest more in bonds, and you'll keep less cash with you. Now, there's one very important concept which you have to understand. If we feel more risk, we will invest less, ma'am. Yes, definitely. अगर आपको लगता है risky है, तो definitely you will prefer to keep more cash, isn't it? And when you feel like interest rates are higher, then in that case, आप क्या करेंगे? Obviously, you will go for investing more because आपका capital gain बढ़ेगा. So you'll gain more capital. Your capital gain will be more. That will be making you to go for more invest. इसीलिए तो लोग property में invest करते हैं. Why do people invest in property? You buy property at less price, और आपको लगता है कि over the Delhi, in any city, land is limited and the property prices are going to shoot up. So let's buy today, and when the prices will go up, we'll sell it off. So when you expect that prices are going to go up, prices in the terms, your returns, interest rate returns, capital gain. When you expect that it is going to go up, then definitely you'll invest in that asset, isn't it? But if you feel like that it's going to be on the downturn, when COVID was there, property prices crashed. So people believed, abhi we are getting at low price. In future, for sure it is going to increase. Isn't it? So when you feel like that it is going to increase in future, then you go for investing because aapka capital gain hoga, aapka ROI high hoga, isn't it? That makes you to invest. So that's the relationship between speculative and I'll share. Don't worry, Janisha. Abhi aap concentrate karo beta concepts pe. That is more important. Okay, so this is clear. Now I want to share one important concept that is about bonds and price of interest rates and price of bond. Are you people aware about bonds? Padha hai aapne? If you have read about bonds, see, basically what happens if interest rate goes up, bonds ka price kam hota jata hai. Why is it so? There's inverse relationship between the interest rate and the bond price. Why is it working? Why is it opposite? Any idea about? So I'll go for this and then I'll take a break. Okay. So after this, we'll take a break. Just let me complete this. If suppose I say bond hai, okay, bond in the market which was introduced last year, and the interest rate quoted was let's say the interest rate quoted say was 4%. Okay, so interest rate quoted was 4%. Okay, last year. And now let's say interest rate has gone up. So it has gone up to, let's say 5%. Okay, so it has gone up to 5%. If the interest rate has gone to 5%, 2022 and 2021, it was 4%. Now the bond which was issued in 2021, 4% interest rate पे issue किया. Last year it was issued at 4%. And now the interest rate on the bond is 5%. Since the interest rate has gone up. Now, if this bond, which was there in the market last year, issued in last year, was at 4%, and the bond who's holding the bond wants to sell it in the market, and uski bond पे 4% interest rate hai, now the new bonds which are issued in the market is at 5% interest rate. Who will buy this bond? 4% pay. When in the market you are getting at 5% today, it's because interest rate बढ़ गया, so you will be getting at 5% interest rate if you buy a bond today, which is giving you at 5% interest rate. But the one which was sold last year was sold at 4% interest rate, and the fellow is in need of money, so goes for selling in the market. The fellow is competing with 4% interest rate with 5% interest rate. आप समझ रहे? So who will buy the bond which is quoting at 4% interest rate? What this fellow has to do? If the bond price is 100 rupees, the fellow has to sell at 90 rupees. Because आप interest rate low दे रहे हैं as compared to the market. So what's happening to the bond price? The bond prices decreases because of high interest rate in 2022. Interest rate बढ़ गया, and that is why this bond, which will be selling in the market, will be selling at a low price. Okay, so that's the concept of bond price and interest rates. बिल्कुल 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 प्रभास, absolutely right. So आपने bonds पढ़ा है, good. So you know the concept, okay? So you understand bond price or interest rates reverse में काम करते हैं. याद रखिए, okay? And we will be sharing the concept later after 10 minutes. So let's go for a break, and then we'll share about how interest rates and Keynes का concept, speculative demand for motive depends. You know the concept. But एक very important concept है जिसको हम break के बाद share करेंगे. Okay, so let's go for break, and we'll meet after 10 minutes. आपका म्यूट कर दो. Okay, so I want to take Jaspreet's query before I go ahead. He has asked for bull and bear. Bull and bear basically Jaspreet means that bull क्या होता है बेटा? Bull is aggressive, isn't it? So bull is optimism. Bull is optimism. Bear is calm, quiet, isn't it? So that is about pessimistic. That means you are not so positive about the market. So bull is on the upturn and bear is about on the downturn. Okay, so just read that's clear. Okay, so I'm happy to see many of you know the concept of bond, and that's good. That's good for you because आगे concept is related है, so आपके लिए easy हो जाएगा. Okay, so if the current interest rate we have shared, then the critical interest rate. You know, in bond there's a component called coupon rate. आपने bond पढ़ा है ना? So coupon rate is critical interest rate. Okay, so critical interest rate and current interest rate. Current interest rate हमने क्या लिया? 5%. And let's say the critical interest rate is current interest rate is 5%, and the critical interest rate of the bond which is offering you at 4% coupon rate. Okay, so that's 4%. So if the current interest rate is greater than the critical interest rate, then what will happen? They'll expect fall in the interest rates, and hence they will invest in bonds because prices come hoga. They'll invest in the bonds, so earn high interest rate on bonds and high expected capital gains. So when this is a scenario, you expect that since the price is less, interest rate is low, it will increase in the future, and that's why you will going for if this is greater, current interest rate is greater than the critical interest rates. Okay, so what it makes you that interest rates are going to fall in the future because abhi zyada hai, so definitely fall hoga. And if it is going to decrease in the future, then in that case you will be gaining the bond because aapne to you have taken it at a low, high price and high interest rates, and those who will be getting, they will be getting at a lower. So if you will sell in the market, then in that case, what will happen? You will have capital gain. Okay, so that's the concept. Okay, so this graph takes care about the concept of liquidity preference theory, which is a classic concept of Keynes, and it deals with interest rates and speculative demand. So what you can see here in this graph, you can see this is about individuals' speculative demand for money. This is about individual speculative demand for money. What you see on the x-axis, you see on the x-axis is speculative demand for money. Okay, money which you want to keep it for speculative motive, and money you want to keep it as cash. Now you see there's interest rate. This is one is given, and this is the critical interest rates. Critical interest rate means जो bond से interest rate मिल रहा है आपको, ठीक है? और ये जो market में interest rate quote हो रहा है. So this is the current interest rate. This is the critical interest rate. If this current interest rate is higher than the critical interest rate, then in that case, what is going to happen? You feel optimistic and you go for investing more and more. But the break which you see here, this point, if this current interest rate is going to go beyond this critical interest rate, if this current interest rate goes beyond this point on the lower side, what is going to happen? So just Pete was asking about bull and bear and optimism and pessimistic. So what's going to happen if this is going to go, the current interest rate goes below this point? People will lose all hope. They believe that it will not go beyond this point. It will not go beyond this point. It will not decrease beyond this point. And it will, so why should we keep money in terms of bonds? Let's keep more in terms of cash. So people go for keeping more cash. So what do you see here in this case? What is going to happen here? In that case, people will go for keeping money in more cash, and the speculative demand for money will not be there. So this you see over here, this dark one which you see, is because here the critical interest rate, people believe that beyond this, it is not going to generate any capital gain for them. And that is why they do not want to invest in bond and they keep money cash. That's why the break is here. When you expect that future you will gain because the critical interest rate is low and the current interest rate is high. So what's the core here? As long as the critical interest rate is less than current interest rate, that makes investors motivated to invest in bonds. And they want to keep less and less cash. But the moment, so is it clear to all of you? Are you getting it or not? So core is that if this current interest rate, this one, you can see is greater than. So current interest rate, if this RTR or whatever it is about current interest rate, if the current interest rate, I'm not able to write with this. Okay, 1 second. 1 second. Okay, so here what we are saying that this current interest rates, this current interest rate R is greater than the critical interest rate. Till the time this is a scenario, there will be people will be going for speculative motive, will be investing basically because they expect capital gain. But the moment this is less than, this gets reversed. If this is going to get reversed here, this gets reversed here, then in that case, you are here. And below this, people lose all hope in terms of gaining any capital gain. And that's why they want to keep money cash. So this is the region where they lose all hope towards investing in the market. Can you recap any example with respect to this? This is known as liquidity trap. So this scenario, which you see here, is about liquidity trap. Any idea about this concept? Any case can you recap with respect to this? Agar aap connect kar sakte hai to. This is what you can see here. What's happening here? Can you see here? I'll erase this and share. So basically, interest rates and speculative demand works in the reverse manner with respect to current and the critical interest rate. Now, what do you see in this case? What's happening here? This is the interest rate. Interest rate quoted here is this R asterisk is the interest rate, isn't it? So which you see here is the R1, R0, R2, R1, and this is the highest which you see here. Now, when you see that interest rate is R asterisk, what's the speculative demand for money? That means you keep more in terms of investments and you keep less cash. But what's happening when you are moving towards right-hand side? As the interest rate is decreasing, people are finding it less lucrative to invest in the bonds, and that's why they want to keep more cash. And if you go to this point M4, M3 to M4, what do you see from M3 to M4? When the interest rate has gone down from R1 to R0, and people believe that now interest rate is not going to increase, then in that case, they lose all hope and they keep money in cash. So they're caught here in terms of liquidity. Liquidity means keeping cash. They do not want to invest in the market because they have lost hope in terms of getting any returns. Yes, Hiral, absolutely right. 2008 crisis. Very good. Bless you. Current and the critical interest rate. अभी तो आपको बताया बेटा current and critical interest rate का example that if we say about दो bonds हैं market में एक bond का return आपको interest rate 2021 में the bond which has been issued in if the bond is issued in 2021 at the interest rate ये इसका critical interest rate होगा at 4%. So this is the critical interest rate. Okay, so critical is which you get the return on it. If you are holding this bond, what return you are going to get is at 4% coupon rate. Okay, and if we say in 2022, the current interest rate is, let's say, 5%. So current is more than the critical. If current is more than the critical, then in that case, what happens? In this case, the bond price will decrease. Bond price decreases means आपको capital gain मिलेगा because you are buying at a low price and you will be gaining later. So this capital gain makes you to invest here, isn't it? So you'll buy a bond because आपको पता है you will gain capital gain through this. So you'll go for investing here. That is how it works. But if you see here, in this case, if interest rate has gone to such a low level at R0, and you believe that it will not increase in future, that means interest is what? Interest is return on your assets. If interest rate has gone to that low and you feel like that it is not going to increase in future, that makes you to keep money cash. So you keep more money in cash and you're caught in a trap. And this trap is known as liquidity trap, which you can see here. Which you can see here. This is liquidity trap. And this liquidity trap means what? You will not go for investing. You will keep your money as cash because you feel that you will not be gaining any capital gain because the interest rate is too low. And rightly quoted by, yes, absolutely right. Hitesh and Hiral has rightly quoted 2008 crisis. Agar aapko pata ho, 2008 crisis, what happened? US government had reduced interest rate to such a low level. Still, people were not ready to go for investing in the market, and they were not ready to have trust in the economy. They lost all hope. So they started keeping more cash. And when you keep more cash, जब आपको लगता है transactive motive, when you keep transactive motive more, we have done Kin's concept, speculative and then precautionary and speculative. So that's a trade-off. आपको लगता है when you want to keep cash because you believe the opportunity cost of holding cash is almost zero, isn't it? When you feel that opportunity cost of holding cash is zero, and then in that case, you want to keep more cash. When you see that opportunity cost of holding cash is more and more, then you will invest more and more. So if you are at RS trick, that means what? Opportunity cost of holding cash is very high. That is why you go for investing. But as you move down the line, when you are caught in a liquidity trap, where you believe that the opportunity cost of holding money is zero, why will you go for putting your money in any kind of investment when you feel that it is as good as keeping cash? So cash is more liquid, so rather keep it cash rather than going for investing. That's the concept of liquidity. Okay, so this is liquidity trap concept. And this is about countries. So wahan pe humne first case pe what we did, we shared first about individual, isn't it? So we shared about here individual. Prior to that, sorry, back. यहाँ पे हमने क्या देखा? We spoke about individual. Individual player decides about, shall I keep more cash? Shall I go for investments? And the next one which we saw, this one is about what? This one is about countries. So country, and the example rightly quoted by Hiral is about 2008 crisis. All across the country, it was believed that economy of US has crashed. People were very pessimistic about it. That's why they thought, let's keep cash. And if you keep cash, that means you are in liquidity trap. Okay, so that is the concept. So 2008 financial crisis, what happened? Interest rate went almost to such a low level, and people thought it's better to keep cash rather than going for it. And government, what did it? Government had gone for our interest rate, interest price directly proportional to bond price. No, no, interest rates are inversely proportional to bond price, Pooja. So this is the concept. Is it clear to all of you? Global financial crisis क्यों हुआ and हुआ, that is a different issue why it happened. But what was the measures taken by US, and it didn't help. So if you know the concept of quantitative easing, what was the concept of quantitative easing? Uh, Government had injected money in the economy. Injected money means easy money was available, but still people were not ready to go for investing because they were caught in a liquidity trap and they lost hope that this is going to generate returns. So when you do not have any expectations, when you believe that holding cost of cash is zero, why will you go for keeping investing your money? If you invest your money, you are losing liquidity also, and then in that case you are getting no returns also, so why should you go for it? So then in that case you're caught in a liquidity trap. That's what the Keynes concept is about. So interest rates and speculative demand works in reverse manner. And because of that, if it is true for an individual, if it happens across the country, that leads to country in liquidity trap. And the classic case of this is global financial crisis 2008, where people income increased because government had gone for easy income, but still people didn't go for transactive. They didn't go for speculative motive. They kept it for transactive and speculative motive. They didn't go for speculative motive. Okay, so that's the concept. Okay, so the next thing which we are sharing here is Baumol's approach. Baumol's approach is about bonds. Okay, so when we talk about bonds, he has shared very nicely, and you will like it. What he shared, Baumol said about like the way industries they do, firms they do. They create inventories. No, they create inventories. Why do they create inventories? They create inventories to take care about future, to minimize their cost component and to gain maximum, isn't it? So if a firm plans about inventory, they plan inventory based on what? जैसे आप देखिए Amazon during this COVID crisis, they had huge inventories. Why did they plan for huge inventory? Because they realized that people will be locked down and people will be ordering more goods. So we should have enough inventory with us and we can go for coming up to the expectations of consumers, and our sales will also enhance, isn't it? So this concept given by Baumol is in terms of inventory. Inventory is in terms of we the people, we create inventory. Just say firms create करती inventory, वैसे we create inventory, and our inventory is in two forms. One is in cash and bonds. Okay, so we create our inventory in the manner where we believe that we'll get maximum benefit by keeping the proportion in such a manner between cash and bonds, which gives us maximum returns and minimizes our opportunity cost. Okay, so the combination to decide about what proportion of income to be kept as cash and what proportion to be kept as bond, and to create that inventory, which will help to minimize the opportunity cost of keeping cash and maximize your capital gain. That's the concept of Baumol. Okay, so Baumol concept is about inventory analysis in the terms of transactive motive. So shall I go for keeping more in terms of cash, or shall I go for going for more of investments? Okay, so this is about the concept. Okay. So I hope you understand. So basically to go for considering the choice between two assets in terms of the store of value, that is, shall I go for money or shall I go for bonds? So shall I go for bonds or shall I go for keeping it in terms of money? And then deciding about taking a call. So medium of payments is the purchase of commodities where bonds do not. So basically when you keep money, then in that case you have exchange transaction motive, you can easily achieve. But if you keep it in bond, then you have store of value. So you have to take a call. Store of value is in bonds. Okay, so in bonds you have store of values. And in the case of money, you have transaction. You can go for transactions. So that is, you have to decide about, that is how you create your inventory. That is what Baumol said about. And the objective is that to go for optimum combination. In दोनों का आप ऐसा unique combination लीजिए where you get minimize the opportunity cost of keeping cash and you gain maximum by returns through bonds. So your yield through bonds should be higher and your opportunity cost of keeping cash should be minimum. That is about the level you have to fix up. That is the Baumol's concept. Okay. So Baumol's concept is to bring balance between cash and bond and create inventory which can take care about, which serves two purposes. Cash is about transaction, medium of exchange, and bond is about store of value. And if you go for store of value, then you're sacrificing your liquidity. So you have to ensure that. And if you go for keeping cash, then in that case, you are sacrificing the opportunity cost of not getting that much return. So that is what you have to decide about. That's the Baumol concept. Okay, so in real world, what happens? You have to decide about your assets. Assets can be different kind of assets. You can have risky assets. Risky assets are assets which are given Baumol's theory in Hindi, please. Shubham, Tanvi, consequences of liquidity trap is that people go for keeping more cash. People are not investing. Just a global financial crisis may go up. Because of that, what happened? Government, people lose hope in investments. Agar investments nahi honge, if you will not go for savings, then how there will be circulation of money? We have shared four sector model. So households, they go for savings where? In banks and financial institutions. Where do they save? And this money goes to whom? That money goes to corporate also, that money goes to government also. So if corporate are not getting income in loans, and at the same time government is not getting enough money, how the economy is going to move? So liquidity trap is not a good condition. Okay. Okay. So Baumol's theory basically, Shubham, जैसे companies portfolio create करती हैं, portfolio in terms of inventories, in the inventories they go for broker fees is about the charges which you have to pay. So if you go for bonds, they'll go for charging. If you go for some investments in the market, they charge certain fees from so that is the brokerage fees. Okay, so broker ki fees, जैसे आपके banks, they charge certain amount of money for rendering their services. Okay, so you go for these services, so you pay the brokerage charge. So what should be your idea here? I'm first addressing Neil's question. If we say about the brokerage fee is higher, so basically what happens is the brokerage fee of bond, suppose you're going for a bond and you have to pay brokerage fee, and let's say interest rate is 5% and brokerage fee is 3%, so net to aapka 2% ho gaya, isn't it? So you have to see that how much brokerage fee we have to pay and how much is gain through bonds, and what we are foregoing by keeping money in cash. So that is what you have to see. That's what is about Baumol's model. Okay, so Baumol says that analyze Shubham. It's about creating inventory. Inventory is in terms of inventory. क्या होता है? Stock आप रखते हैं अपने पास. that is inventory. We have done in national income accounting also. Inventory is kind of investment. So you create inventory which helps you to meet the demand in the future. And similarly, the way the firms they do, similarly people they go for going for it in terms of creating their inventory, balancing between cash and bonds, which can help them to mitigate their risk, to minimize their risk, also to gain also capital gain also, at the same time taking care about brokerage fee also, and the transfer cost. Transfer cost basically ये है कि अगर आप cash रख रहे हैं, there's zero cost. If you go from cash to bonds, so what cost you are incurring? Okay, what cost you are incurring? That is the transfer cost from cash to bonds. What cost you are incurring? Is it worth going for that cost? Yes or no? So accordingly, you take a call. Okay, so that's the concept. Karthik is saying, if people won't save, they will spend and create demand, which will result in circulation of money through spending of households. So this can also be the source of money. No, Karthik. What happens that if you're in a liquidity trap, then in that case, spending will not increase at that pace. No, because what will happen if spending is not? You people are not spending to that extent. 2008 crisis, if you know about what happened in 2008 crisis, government was giving money was there, but still people were not spending, people were not investing in that country because they lost all hope. India ke banking stock at that point went up because Sara Paisa they started investing in developing countries where they believe that it is more safer to invest over there. They were not investing in their home country. So when you lose that hope, then it's a problem. How will you bring your economy back on track? So it's a circular flow. It's a circular flow. If you are spending and corporate are not investing, so how the production will happen? How the production is going to happen? So investments require cost, and that cost has to be met through financial institutions and through finance, because you understand that somewhere or the other they have to raise money. Kahan se aayega paisa to go for capital expenditure by force? It cannot be achieved through simply you create a demand and they can achieve it. So basically what we are talking here, Baumel's model is clear. Baumel's model, Shivam. Baumel's model is clear to you. I hope so. So individuals kya karte hain? What do they do basically? They decide about their expenditure. We have income of let's say 1,000 rupees and we have to spend on different parameters. Let's go for deciding about that what percentage of income shall I go for keeping it in bonds and how much should I go for keeping it in cash? And how much do I have to withdraw? Agar aapko withdraw karna hai, to then in that case, you have to pay certain fees for that. And what is the price you are paying for withdrawing? So you have to take care about the component of the fixed cost for keeping money with you and what you are losing. And second is about the variable cost. Agar aap transaction karte hain, bond se cash mein, cash se bond mein, so kya cost involved hai aapki uski? That is about the another cost. So you have to take care about brokers' commission. Just different players are there. See, here too they have given an example only of bonds, but people go for investing in shares, people go for investing in other things. So you have Religare, you have Muthoot Finance, you have banks, you have asset management companies. They guide you, they advise you, they help you to create your portfolio, but at the same time they charge also. And if you go for a fixed investment, then if you go for taking it prior, then in that case, what happens if you take it prior, then they deduct certain charges, isn't it? Har cheez ki cost involved hoti hai. These players, how they are surviving? They are taking money from us. Through that, they are meeting their expenses. So they charge brokerage fee. Similarly, insurance mein aap dekhiye, so you have to pay certain amount. Agar aap ULIP lete hain, then you have to pay certain amount as a brokerage fee. Okay, so that's important. Okay, so this is what I believe Baumol's model is clear to all of you. Okay, so you understand that what are the two motives? This अभी तक आप कोर्स समझ गए हैं. There are only three motives. One, you go for transactive, speculative, and precautionary. So definitely transactive is the most important motive, because money you need for transactive motive first and the foremost from anything else, isn't it? And secondly, if you go for transactive motive, then in that case, or a medium of exchange, then what is the cost of foregoing investments, the rate of interest? Okay, so आपकी एक cost होगी. What is your one cost? Cost is your interest rate, isn't it? So cost of interest, interest rate of money is the first cost जो आप forego करेंगे if you will not invest. Second is the cost of bank. अगर आप बैंक से withdraw करेंगे or you go for putting money from cash to some investments in the bank, then there's certain cost involved. So that is the second cost. So first is the interest cost, which you may forego, and second is the cost which you are going to bear or you are going to get rid of by switching over from A to B. Cash से आप bonds में जा रहे हैं या deposits में जा रहे हैं, or you are going from deposits to cash. And if you are going from cash to deposits, then what is the rate of interest you will be getting and what you're foregoing. So these are the two components of cost. Based on that, you decide about that. Shall I go for transactive motive or shall I go for this? So what inclines you? Interest rates. Interest rates. We have shared. Interest rates jitna higher hoga, utna aapka transactive motive demand kam hoga. That is why during inflation, to get over this transactive demand, they go for increasing interest rates. Okay, so that's the core. So cost component kya ho gaye? The cost which you are foregoing by not having that interest because you are keeping your money in cash. Other is that if you would go for having it, then in that case, what cost you're going to incur. So both the cost component you have to take. One can be plus, one can be minus, or both can be plus together in this case, depending upon आप क्या कर रहे हैं. Are you going for switching over from withdrawing your money from the bank, or you're putting your money in the bank? Okay, putting your money in the bank, then bank will give you advisory services. See, आप इसमें डाल दीजिए पैसा, आपको high returns मिलेंगे. So they are giving you certain services, and on that they'll charge certain amount of money from you. जैसे SBI caps है, SBI Capital Services है, PNB Capital Services है, ICICI Securities है. So these people, they go for putting your money. At the same time, they charge certain money from, but at the same time, you also get returns. So that you have to weigh. You have to minimize your cost and you have to maximize your gain. And cost minimization is in terms of opportunity cost. Okay. So Milton Friedman is the new economist, neo Keynesian economist. Okay. So they are the modern economist category people, Milton Friedman. And he said that what Keynes said about income, which is disposable income, isn't it? Income. But this fellow, Milton, said about permanent income. Permanent income means income of, it is inclusive of wealth also. Okay, so wealth also. So it's not about income, it is inclusive of wealth also. So those who have surplus income from the past, that's about permanent income. So the permanent income represents the total income or the total wealth, which you can see here. Total wealth is the permanent income. So permanent income in terms of, so that's what Friedman differed about. So Friedman from Keynes said about this income, but this fellow said about wealth, total wealth. Okay, so total wealth about permanent income. So he said about permanent income divided by discount rate. Discount rate कौन सा होता है? Discount rate is a concept. Interest rates. Okay, so divided by the interest rate talks about the average return on the asset classes. So in discount rate is interest rate. Agar aapne invest nahi kiya, then in that case, what is the level of discount interest rate you're foregoing? One. Secondly, if I say that inflation goes up, let's say that you have invested today 1,000 rupees at the rate of 6%. And let's say inflation goes up to 5%. So if inflation goes up to 5%, आपका net कितना होगा in future in terms of if you have to discount, no? The interest rate you have to discount. So net gain 1,000 at the rate of 6% तो नहीं होगा, बल्कि it will be only 1%, isn't it? Because 6% minus 5% is 1%. So you have to go for discounting. Present value, future value concept पढ़ा है ना आपने? So that's about discounting. Okay, so you have to discount. You have to go for discount rate, and then you calculate your return on assets. So how do you go for discounting? Present value, future value concept, you know, PVs and FP. So if you want to calculate for the future value of your permanent income, you have to go for taking care about the discount rate. What is the level of interest rate? What is the level of inflation? Respectively, आप अपनी value assets की calculate कर सकते हैं at a future date. What will be the level of return you will be getting? That's what Milton Friedman said about. Okay, and Keynesian spoke about only bonds. But Milton Friedman spoke about equity also, physical capital also, human capital also. Okay, so this is a broader concept. So Milton Friedman took care about asset classes, not only confining to bonds, but also equity, physical asset capitals, and human capital. So it's about permanent income, which is there over a longer period of time. You may have machines, you may have land, you may have some property with you. That is also part of your asset. So the asset class was redefined. The range which was included was much broader as compared to Keynesian concept. That's the difference. Then second difference is that he said about demand for money is about permanent income and relative returns on assets. So you have assets which are categorized as bonds, equity, physical capital, and human capital. And the returns which you get on these assets is plus in your permanent income. So permanent income plus return on these assets together decides about your demand for money. Isn't it? It's not only confined about how much income do you have. Sometimes you calculate, you decide about your expense pattern based on आपने कितना investment किया है, उससे future returns आपको कितना मिलेगा. Isn't it? Then you plan about, shall I go for this? Shall I buy this or not? So that's what Milton Friedman said about. Okay, another important concept here shared is that as the price level goes up, money demand goes up. We have already shared that. We had shared from Fisher till now. So Sare economists, if you see all across, all throughout which we have shared, they have highlighted all throughout one major concept that the price level definitely makes impact on money demand. If the price level goes up, money demand goes up because the value of money decreases. And this is what we have shared in the concept when we were talking about the functions of money, if you recap. Okay, so if inflation rate goes up, opportunity cost of holding money increases opportunity cost of holding money. If inflation goes up, interest rates, then in that case, you have to keep more money in cash because you have to spend more. And if you have to spend more, then you're foregoing all interest payments. So opportunity cost is high in the case of inflation. Okay, so that is to be taken care. So Friedman introduced, Keynes took care about that, and the classical economists took care about money demand, which emphasized only in transactive motive. So Keynes made the concept significant difference from the what classical economists said about. Classical economists gave importance to what? Only transactive demand. Core was transactive demand because they believed it's a full employment, so it's fine. Okay, Keynes brought what? Keynes brought speculative demand also. That was a very important concept. So he brought The main drawback of Keynes' speculative demand was that he only took care about bonds. He said he visualized investments agar hoga, keval bonds mein hoga. But that was not realistic, isn't it? People invest, especially in Indian context, people hardly invest in bonds. People majorly invest in shares and others. So that was the difference. That was a rather drawback of Keynes' concept. But the plus was that he took care about what? He took care about speculative motive, which is very important component apart from transactive motive. So classical economists took care about transactive motive when they defined demand for money. So according to them, demand for money was about transactive motive. But Keynes brought about the concept of speculative motive, but the constraint was that he confined himself to bonds only. Okay, that was not realistic to that extent. People go for investing in others also. Then we saw that Tobin and Baumol said about balance between cash, bond, and creating a portfolio and inventory. And Milton Friedman also spoke about permanent income, and he also shared about that assets are not only confined to bonds, it's also about physical capital and human capital. Everything is included in asset. And then asset is about risk. So risk you have to define on the basis of risk, relative risk. He took care about relative risk. And then you decide about that how much percentage we should keep cash and how much we should go for investing in different assets. And assets, is governed by interest rates. So bonds and shares and physical assets are all governed by interest rates. So when you talk about speculative motive, important concept is interest rate, because interest rate governs bonds, interest rate governs return on your shares, interest rate governs the cost and the returns which the firm can derive through physical assets in the future. Okay, so that's the concept of money demand for money. We have shared, we have transited from transactive demand to speculative demand. We have taken care of the assets which have broadly defined from confined to bonds to everything taken care by Milton Friedman. We have shared the drawbacks of speculative demand shared by Keynes, but H as compared to classical economists. So Tobin was another economist who took care about interest-bearing bonds, and we have already shared he categorized assets in the case of safe assets and risky assets. And he spoke on the same line which we have shared about Bowman, creating your portfolio, balanced portfolio between risky and safe. And those people who are less risk-prone, definitely they'll go for putting their money more in bonds and less in others, risk-prone. And at the same time, as you have quoted, that the returns will also be less. Okay, so in Keynes' analysis, individual holds his wealth in either all in money or all in bonds for the future rate of interest we have shared. हमने देखा when interest rate is, when people expect that critical interest rate is too low and the current interest will not be going up in that case, then people lose hope. Then they do what? They keep all cash. So that is what this Keynes notion is about. Okay, so they may keep, but एक extreme हमने देखा था when interest rate was too high. Then the critical interest rate, people had kept all in bonds. So that is the extremes which Keynes had shared about. Okay, Tobin took care about diversifying the portfolio between the risk and return. So diversifying risk by going for investing in different. So creating a portfolio with risk, some risk component and riskless in terms of cash. So demand deposits, मैंने आपको बता दिया, demand deposits are your saving deposits, which you deposit, save money in the banks. And in that case, you go for checks through which you demand money and the bank is liable to pay you. So demand deposits. But then there are treasury bills. Treasury bills are issued by Government of India. These are zero risk. So some people go for investing over there also. So portfolio is defined in terms of bonds and shares. So Tobin and Friedman gave more realistic picture by taking care about assets in terms of bonds, shares, equipments, human capital, everything. So that is how the definitions and the theory of money has been defined over the period of time. Okay, so risk depends on attitude. So as I shared, youngsters, they go for taking more risk. So they may invest in risky ventures, and maybe they go for more equity investments. But people, as they grow old, they become more risk averse. So they may be investing more in less risk prone assets. Okay, so that's the concept. So we have shared Tobin, we have shared Friedman, we have shared Kins, we have shared Fisher, we have shared Pigou. So we have shared all the concepts. I hope it is clear to you. Crowding out, I want to share before we wind up for the day, because this was the question raised. See, crowding out is with respect to the last class, what we shared. What happens when the government starts spending? Okay, when government starts spending to revive the economy, then in that case, government needs money to invest and to spend. So government will borrow money. Government will borrow money means interest rates will increase. So once interest rate starts increasing because of government borrowing, then in that case, private players are disincentivized. They are disincentivized. So we had shared pump priming and we had shared compensatory spending. Compensatory spending mein kya hota hai? When private players are not investing, then the government goes for investing. That is one. But if through pump priming government is investing and government goes for spending more and more, and in that case, if government is not having enough money, then in that case, what is going to happen? Government will borrow to meet those expenses. Government borrows means interest rates will increase. Interest rate increases means corporate, those who may be willing to go for investment, they will be out of the market. So what is happening? Because of government spending, private players are moving out from investing, from more production. So that is crowding out. So what's crowding out here? Crowding out means private players are quitting from investments because government is investing and government is going for more expenses that demotivates private player to go for it. Reason being the interest rate may increase. Reason being they may feel that since government is investing so much, so why should we go for investing? So crowding out is negative impact of government spending in the economy. Okay, so that's clear. I hope so to all of you. Thank you, Shubham. Thank you so much. Bless you. Okay then. Kartik ka query kya hai? I've already sorted out. Okay then. Okay then. Bye. Take care, all of you. Good night.